Great, it's 30:30, so we're going to get started. Sophie, over to you.
Thanks very much. Hi everyone, welcome to our talk on the Compensation Recovery Unit. Our aim today is to explain how the scheme works and also to run through some examples which should hopefully give you an idea of how the rules are applied in practice. The caveat to that is that real life examples are always a little bit more complicated, so inevitably we've used simplified examples just to illustrate the way that the mechanisms work. So without further ado, let's get on.
Okay, so I'm going to start with an introduction to the Compensation Recovery Unit scheme, and that's what CRU stands for. And the basis of it is the Social Security Recovery of Benefits Act 1997. And that act provides for the fact that the defendant has a liability to pay benefits that the claimant has received during the relevant period in respect of the accident, injury or disease back to the Compensation Recovery Unit. We'll come to what the relevant period is shortly. But in terms of what that means is it means that the defendant's liability in these cases is triggered by virtue of them making a compensation payment to the claimant. The key thing for a defendant is that when they get a CRU certificate, they have to pay back all of the benefits on a CRU certificate. But they can offset certain benefits against certain heads of loss to reduce those payments that they're going to have to make to CRU. And in some circumstances, those payments can be sufficient to reduce the benefits, recoverable benefits, down to nil. What's important to know is pain, suffering, and loss of amenity damages. And damages for future losses are ring-fenced, so no deductions can be made in respect of those losses. So, key question is, what is offsettable? Your starting point should always be the Social Security Recovery of Benefits Act 1997. Now, we don't usually recommend that the starting point for everybody is always to go straight to the Act. We know that it can sometimes be one of those jobs where you're not really sure what you're looking for and you're rifling through, that sort of thing. This is not one of those acts. This is one of those acts that is in fact really clear in terms of being able to be used and it's being functional. And in particular, you're looking for Schedule 2, which sets out a really useful table in providing for what benefits are recoverable against what head of loss. Dead clear, simple, easy to follow. And in this case, I would recommend that anybody who's not certain goes back to the Act. So the key elements are loss of earnings, loss of nobility, and care and assistance. Those are your heads of loss. Starting with compensation for loss of earnings, I've listed them here, and you can see that compensation for loss of earnings is referable and deductible by reference to all of these different heads of benefits. So the obvious ones are things like universal credit, employment support allowance, you've got disablement pension and job seekers allowance. Those are the ones that we come across very regularly. But you also need to be aware of sickness benefits being offsettable and statutory sick pay also being offsettable. In terms of care and assistance, those are in the left-hand column here, and the things that can be offset there against care and assistance claims are attendance allowance, the daily living component of personal independence payments, so PIP, that's the one we see a lot, care component of disability living allowance, and the disablement pension. Now, compensation for loss of mobility, it's a slightly less tangible head and it can be used against a couple of things. So you've got the obvious things in terms of vehicles, adaptive vehicles, that sort of thing. But actually where there are travel expenses that have been incurred as a result of a person's loss of mobility by virtue of their injury or disease, that sort of thing, they can also be offset. And those benefits that are offsettable are the mobility allowance, the mobility component of PIP, again, that's one we come across a lot, and the mobility component of disability living allowance. If you're not certain, and this is one of the things to be aware of, if you're not quite certain whether or not the benefit is a consequence of the injury or it is a consequence of pre-existing symptoms that might have existed in any event, and it's quite common for those to be issues in clinical negligence claims, be aware that the Compensation Recovery Unit have a specialist clinical negligence panel whose job it is to actually help kind of disentangle those sorts of cases. I found in the past that sometimes going through the DWP records can also be useful in identifying what a claimant is saying, their ability or inability to do certain things is referable to. So, you know what the offsettable benefits are. The next important thing is what is the relevant period that they are offsettable against. And this is dealt with in section 3 of the Act. And in summary, you're dealing with a 5-year period. And so in accident or injury cases, it's 5 years from the date that the accident or injury occurred. In disease cases, it's 5 years from the date that the claimant first claims a relevant benefit. And so there's usually no practical difference in terms of whether it's accident, injury or disease, but you might have a case where, for example, somebody develops a disease and then they kind of struggle on at work for a little while before stopping. And that's why that definition is provided in terms of that distinction. The vast majority of your cases, however, are going to be that 5-year period from the outset. However, your 5-year period doesn't just run as a 5-year period. It can, in fact, end before the end of 5 years in certain circumstances. So your 5-year period can end if a compensation payment has been made in final discharge of a claim. And in such a case, the period ends on the date that that final payment is made. The second scenario can be in circumstances where there's an agreement made that an earlier compensation payment is treated as being in final discharge of a claim. And again, that will then mean that you end at the date of the agreement. In both of these scenarios, what you can see is that it's effectively kind of a situation where you've got compromise or an agreement that determines the end of that period. And so it isn't always going to be the case that you have the straight run of a 5-year period. The regulations that we've referred to in this slide as well, they amend slightly tweaking the original legislation, and they just provide for the special rules when you're dealing with payments into court and structured settlements. But the reality is there isn't going to be any significant difference. You're still dealing with situations where you've agreed or compromised a claim, and your period is usually going to end at that point. Sophie's going to talk to you through a few examples just of those initial slides that we've dealt with.
I realise I'm doing a bit of a disappearing act here. I've got a magic trick where I take a sip of my water, or certainly a moment ago I'd disappear, but you'll just have to bear with me in that respect. So we're going to look at 3 examples, just applying the basic scheme which Abby has talked you through. So in the first example, we have a situation where Mrs. Jones settles her claim for £75,000 gross of CRU, and that's comprised of general damages of £50,000 and past loss of earnings of £25,000. There is a CRU certificate which has £30,000 of benefits listed, and all the benefits listed are offsettable against loss of earnings. So what happened? Well, we know that the defendant pays the £30,000 on the CRU certificate to the Compensation Recovery Unit. The next question is, what is offsettable? Now, because the benefits listed on the certificate are offsettable against past loss of earnings, and past loss of earnings is £25,000, £25,000 of the damages are offsettable. So the net damages due to the claimant are £50,000, and that is the figure that the defendant pays to the claimant. Moving on to the second example, this is one illustrating the idea of the relevant period, and it might not be something that you get in practice, but we want to show you how it works with a practical example. So we've got a situation where an accident happens on the 30th of March 2016. After that accident, there is a universal credit payment of £10,000 and a daily living component of PIP £5,000, and those benefits are paid, totaling those amounts up until the 31st of March 2021. So up until the period 5 years after the accident. We then have some further benefits £5,000 universal credit and £2,500 daily living component of PIP, which are paid from the 1st of April 21 to date, so after that 5-year period. The claim settles for £100,000 gross of CRU, and this is something which is explicitly stated to be subject to CRU deductions. And what the defendant says is, well, the net amount you get will be £77,500. So all those benefits which are listed there, including those from the 1st of April 21 onwards, are offsettable. Now, is that right? Well, the answer, we think, is no, it's not. We think that only £15,000 will be offsettable, which would give a net figure of £85,000. Now, looking at this table, that breaks down the claimant's claim here. We've got general damages and future loss of earnings and future treatment, all of which are ring-fenced. What we do have is a past loss of earnings claim of £30,000. We know that the universal credit is offsettable against that, but only the universal credit up until the 31st of March 21 is offsettable. And similarly, with past care, the daily living component of PIP is offsettable, but only the £5,000 in the relevant period. So that's how we get to our figure of £85,000 net. Third and final example in this section is a situation where there is an accident on the 1st of January 2020. And the claimant in this case has a loss of earnings claim of £4,000 on the basis that they're off work from the date of the accident until the 1st of March 2020, so roughly 2 months. The CRU certificate, however, records £2,000 universal credit, which has been paid to the claimant from the 1st of June to the 31st of December 2020. So a different period for the loss of earnings claim. In this scenario, the £2,000 on the CRU certificate is still offsettable against loss of earnings. And unless there's a review or an appeal, that's the situation. So over to Abby now.
Yeah, so back to me to deal with the issue of Part 36 and CRU. And the reason that this is important is essentially because you get an offer through the door, or you're making an offer, you need to know exactly what it is that you're telling the client that they will be walking away with. And so the first basic question, which everybody will be dealing with, which is the key, is knowing if your offer is gross or net of CRU. It is somewhat teaching you to suck eggs, I'm sorry about that, but gross means there might well be deductions yet to be made. And net generally means it should be what the claimant walks away with, but just double check your wording to make sure that it is clear. But that's straightforward. And what do you do in circumstances where you get an offer and the wording isn't clear? Well, if you're for the claimant, you have a benefit here because Civil Procedure Law 3622 provides for what offers by a defendant have to state. And so you can see here that 3622(3) states that a defendant who makes a Part 36 offer must, where relevant, state either A, that the offer is made without regard to any liability for recoverable benefits or recoverable amounts, or B, that it is intended to include any deductible amounts. Therefore, what this means is the defendant's offer has got to make clear whether it is a gross or net offer. Looking at the circumstance, name and amount of any deductible benefits by which that gross amount is going to be reduced, and the net amount of the compensation. So you should be able to say to the claimant, if they've had an offer made to them, this is how much you are going to be walking away with. And the offers I've seen dealing with this usually say essentially what point that the offer is made up to. And so, for example, and so if an offer is made on the basis of CRU dated up to today's date or next week's date, that sort of thing. If the defendant doesn't yet have a CRU certificate, but they've applied for one, they've got to clarify the offer in the terms set out in 3622(6), no later than 7 days after the receipt of the certificate. And so it isn't good enough for the defendant to apply for that certificate, make an ambiguous offer, sit on it when that certificate comes in and not clarify it. The rules require that that clarification has to be provided to the claimant. Some tips for the claimant here. By contrast, Civil Procedural 36 does not provide that the claimant has to provide the same information to a defendant in terms of setting out the basis of the offer. But being sensible, it might well be tactically worth you doing so. For example, if you're making an offer and you specify your heads of loss in terms of loss of earnings, care and assistance, anything to do with mobility at the lower end of any valuation that you provided to the claimant, and it is then an accepted offer based on that breakdown, there's going to be less CRU deductible and more for the claimant going to be walking away in their hands. Equally speaking, it can practically be really useful to break down the offer, because that means it's absolutely clear when you're advising the client of what it is that they are going to get in their hand. As such, whilst the defendant can't turn to the claimant and say, look, we've got CPR 3622, you've got to provide us with this information, nonetheless, it might be circumstances in which a claimant wants to provide that. The other thing I'm going to factor in here as well is that it's also worth bearing in mind that we know that Part 36 offers are not made in isolation. And so we're dealing with them today in a kind of hypothetical scenario where there isn't really any litigation risk. But you also have to factor in that if there are issues such as potentially fundamental dishonesty, those sorts of things, there might be circumstances in which going back, asking for additional clarification, taking longer, it might not be beneficial in terms of the claimant, and it might be better in some circumstances for them to accept an offer and walk away with something rather than run the risk of an offer being taken off the table. There are also rules providing for what happens if CRU is ongoing from the date since the Part 36 offer has expired. And so you can see here CPR 3611(3)(b) sets out that where the relevant period of the Part 36 offer has expired and nonetheless further deductible amounts, so further benefits have been paid to the claimant and you're still within the relevant period, permission is required to accept an offer. And that was something that was a bit of a surprise to me. I'd not come across this before, but it's something that is worth noting. And the reason, realistically, is when you look up the next rule, which is 3622(9), which is in such circumstances, the court might direct that the amount of the offer payable to the offeree shall be reduced by a sum equivalent to the deductible amounts paid to the claimant since the date of the offer. And so if, for example, since the date of the offer, a further £5,000 worth of offsettable benefits have been accrued, it is possible for the court to say, well, that additional £5,000 should be added to the deductible benefits, and so the claimant's damages that they walk away with in their hand should be reduced accordingly. But bear in mind it's a may, which means there's some discretion there for the court. So it gives scope for counsel who like to have a bit of an argument about things to have a bit of Barney and to work out whether or not they are going to succeed or not, and to see where it's worth running the arguments. In terms of net offers, they're a little bit more straightforward, but it generally involves doing a slight amount of maths to work out whether or not a claimant beats a net offer at trial. And so these are circumstances where the defendant has made a net offer and the claimant has nonetheless not accepted that and they've gone off to trial. And in such cases, you take the judgment amount, you deduct the offsettable benefits as they exist at the date of trial, not as they exist at the date of the Part 36. And if the claimant walks away from trial with more than was offered net in that Part 36 offer, he's beaten the Part 36 offer and happy days. But if the claimant walks away with less than was offered net, he's not beaten the Part 36 offer made by the defendant, and so is going to be subject to the Part 36 consequences that we are all familiar with. So I've talked a fair bit about what the rules are and how it works, and we then turn to some examples. And so by way of example, you've got the claimant who is involved in an accident at work. The defendant offers to pay him £18,000 net of CRU, and at that point, the CRU is £16,262. The claimant goes to trial and he's awarded £29,550. Don't worry, I don't need you to get your calculators out. I've done the maths for you at the bottom here. But what you need to know, the important thing, is that at trial, the revised CRU certificate had in fact gone down. And so it might be unusual, it might not happen all the time, but in fact, it can happen, and just be alert to that. Because the problem that meant was that the defendant's offer had been beaten by the claimant, because £29,550 less the £6,760 of deductible benefits at the date of trial is £22,789. It's more than £18,500. And so the claimant has beaten the Part 36 offer. And it's a bit of a blow for the defendant, because obviously if the CRU certificate hadn't gone down, they would have beat the Part 36 offer. But it's just an example of demonstrating the need to be alert to what is and isn't recoverable, is and isn't offsettable. And if there are errors with that CRU certificate for a claimant, it might well be worth reviewing them and having it considered in the way that Sophie is going to discuss shortly. I should say this example is pulled from a case. And so it might seem a little far-fetched, but I promise you it was in fact what happened in real life and was subject to some appeals as well. Right, we're going to turn over to Sophie now to deal with contrib.
So dealing with contributory negligence, the Act, which we've looked at already, doesn't make any provision for reduction of recoverable benefits to take account of contributory negligence. The position is different for NHS charges, but we don't have time to go into that within the scope of today's talk. But the effect of the position is that even if there is contributory negligence, the defendant has to pay 100% of the amount on the certificate, subject to the rules we've looked at. And provided the head of loss net of contrib exceeds the deductible benefits, 100% of the amount on the certificate is offsettable against the claimant's damages. So I just want to look at a couple of examples illustrating that point. So in this case, the claimant's got a loss of earnings claim on a full liability basis of £50,000. And we've got a CRU certificate which has £20,000 universal credit on it, which we know is offsettable against loss of earnings. Now, liability's been agreed 25/75 in the claimant's favour. And the claimant's loss of earnings claim, net of contributory negligence, we can work out, is £37,500. Now, the defendant makes a Calderbank offer of £80,000 gross of CRU and contrib, but there's no breakdown in that. Now, working that out, we can deduce that the claimant's entitled to £40,000 net. So what we do is we look at the total offer net of contributory negligence, which is £60,000. And then we look at what CRU we can deduct from that. And because the claimant's loss of earnings claim net of contrib here is £37,500, we know that the full £20,000 will be deductible from the £60,000. So that's how we get to the figure, the net figure of £40,000. Now, the second example is on similar facts, but here, the claimant's loss of earnings claim on a full liability basis is £12,000. Now, what the defendant says when the claimant accepts its offer of £80,000 gross of CRU and contrib is that, well, claimant, you're entitled to £48,000 net. And the way we get there is we take the 25% contrib off our offer of £80,000 to get to £60,000. And then your loss of earnings claim is £12,000, CRU's £20,000, so the full £12,000 comes off and you get £48,000 in your hand. Now, the question is, is the defendant right? And given that we're in a webinar and we can only communicate via text, it's a rhetorical question. In our view, the defendant's wrong because they've missed out a step in the process, and that step is to work out what the claimant's claim for loss of earnings net of contrib is, and that is £9,000. So instead, what should be done is to deduct that £9,000 from the £60,000 to get to £51,000. Now, the rationale for that, in our view, is that the defendant's method would mean that £3,000 was being offset against PSLA or a different ring-fenced head. But the bad news for the defendant is they've still got to pay 100% of the amount on the certificate to the CRU, but unfortunately, them's the breaks. Now, the final part of the talk just looks briefly at the two routes by which a CRU certificate can be challenged. And there are two options open to the parties. The first is review and the second is appeal. Now, looking at a review, the CRU can review a certificate on application or of its own motion, and there's no time limit. And the grounds for review, as you can see, are very wide, and they're set out there. So a mistake in the preparation of the certificate, the benefit recovered from the defendant is in excess of the amount due to CRU. The amount on the certificate is too low due to incorrect or insufficient information being supplied to CRU by the defendant. And just pausing there on that number 3, this is the only mechanism on a review by which the CRU can actually increase the amount on the certificate. And the final ground is that a ground of appeal exists. So the review process is actually a very wide process. Moving on to appeal, these are the grounds for appeal. There are 4 of them, and they're set out there on the slide. I'm not going to read them out, but what I do want to do is just touch upon the significance of the second potential ground of appeal. And what I want to do is just flick back to our example 3. So let's do that. Here, we had a situation where a claimant was in a position where £2,000 of CRU referable to a period of loss of earnings not accident related was offsettable. Now, you can see how an appeal, just go back to this slide, under the second ground could be an option here on the basis that the benefits which were paid to the claimant for that period off work weren't actually paid in respect of the accident. Now, I'll just end with a few points about appeal. Now, you can't appeal until the claim for damages has been finally disposed of and the CRU has been paid. So that means a defendant has to pay the CRU certificate before the appeal right crystallizes. And unsurprisingly, there is a mechanism, if a successful appeal is made, for repayment to a defendant. You need to appeal within a month of the defendant paying the CRU. You can see here that there are some differences to the review process. There's a time limit and you need the payment of the claim for damages and the amount paid on the CRU certificate. So that's a whistle-stop tour, really, of the 2 routes to challenging a CRU certificate. It's more complicated than that, but we can't really go into it in much more detail within the confines of this talk. So that is, to use the word whistle-stop again, a whistle-stop tour of CRU, and hopefully we've given you some practical examples of situations that you might find in practice. We've put our emails there on the slide, so if you do have any queries about the talk or any issues of your own in practice, feel free to drop us a line.
Yeah, so just to pick up where we were, if there are any questions, we're happy to answer them. I'm just going to turn off the recording before we start taking them, so don't worry, any of your questions will be private. I know Michelle, excuse me one second.